Risk Management in Trading, Techniques to Drive Profitability of Hedge Funds and Trading Desks, by Davis W. Edwards. This is a book summary. Imagine being at the helm of a billion-dollar hedge fund, navigating a sea of market risks where one wrong move could sink everything. The stakes are high and the pressure is relentless. Every tick of the market could mean millions gained or lost. But here's the twist. These traders aren't just gambling with their investors' money. Behind the scenes, they're using sophisticated risk management techniques that transform uncertainty into opportunity. It's a game of strategy, calculation, and, sometimes, pure nerve. How do they do it? What secret strategies keep these trading desks afloat? And, more importantly, wildly profitable? Well, today, we're diving into the world of high-stakes finance to uncover the secrets of risk management in trading, inspired by Davis W. Edwards' book, Risk Management in Trading Techniques to Drive Profitability of Hedge Funds and Trading Desks. This isn't just about avoiding losses, it's about making the right moves to come out on top, even when the odds are stacked against you. Whether you're a curious investor, a financial pro, or dreaming of becoming the next Wall Street wolf, stick around because this is about to get real. We're breaking down the strategies the pros use to turn risk into reward and how you can apply them to your own investments. When we think of risk, we usually think of danger, something to avoid at all costs. But here's the twist. For hedge funds and trading desks, risk is not the enemy. It's an opportunity. Edwards' book makes one thing clear. Managing risk is not about avoiding it but mastering it. It's like sailing into a storm, not to escape it, but to ride the winds faster to your destination. Imagine a captain steering his ship not away from the storm clouds, but directly into them, because he knows the winds within can carry him faster to his goal. That's the essence of risk management in trading, using the power of volatility to propel profits. Now, let's get real. Risk is everywhere in trading. Prices can swing wildly, trading partners can default, markets can crash without warning. The question isn't whether you'll face risks, it's how you deal with them. According to Edwards, there are 4 main ways to handle risk, and mastering these is the difference between sinking and soaring. Avoidance. This one's simple. If the odds are terrible, just don't play. Think of it like folding a bad hand in poker. In the world of hedge funds, that might mean avoiding markets that are too volatile or investments that don't align with a fund's core strengths. The trick, knowing when to walk away, is just as powerful as knowing when to double down. Controlling risk means setting boundaries, daily profit and loss calculations, position limits, and diversification. Edwards explains how traders use metrics like value at risk to quantify potential losses before they happen. It's like having guardrails on a mountain road. Sure, the turns are sharp, but you're not flying blind. Transfer. This is the art of offloading risk to someone else. Hedging, for instance, is a classic move. Imagine owning a portfolio of tech stocks and buying options that profit if those stocks fall, just in case. It's not about being pessimistic, it's about preparing for the worst while aiming for the best. Acceptance? Last but not least, sometimes you just have to embrace the risk. Think of it as calculated risk-taking. Accepting risk isn't about recklessness. It's about aligning risks with your strategy and having a budget for potential losses. For hedge funds, that means allocating capital to high-risk, high-reward trades, but never more than they can afford to lose. The goal is to balance these techniques to maximize profits without capsizing the portfolio. Edwards compares it to a tightrope walker. Lean too far in one direction, and you're done. But find that perfect balance, and you can cross even the most treacherous financial landscapes. Sounds easy, right? But this is just the beginning. As we dig deeper, you'll see that mastering risk is as much an art as it is a science. Before traders risk a single dollar, they turn to a powerful tool, backtesting. Think of it as a financial time machine. one that lets you peer into the past to predict the future. It's like if Marty McFly and Doc Brown swapped the DeLorean for a Bloomberg terminal. Traders use backtesting to replay years of market data, testing their strategies against every twist and turn the market has thrown. And here's the catch. If the strategy flops in the simulation, it's back to the drawing board. No actual money is lost, just the pride of a trader whose foolproof plan fell apart at the seams. Edwards emphasizes this as a crucial step, because in trading, hindsight is not just 20/20, it's profitable. In his book, Risk Management in Trading, he lays out how backtesting isn't just about seeing if a strategy works. It's about understanding why it works or doesn't. It's about digging deep into the numbers, tweaking variables, and running the test over and over until you're sure that your strategy isn't just a fluke. Think of it like rehearsing for a high-stakes performance. No room for errors when the curtain finally rises. And let's be honest, without backtesting, every trade would feel like a shot in the dark. Markets are notoriously unpredictable. One day you're riding high on a tech rally. The next you're watching your portfolio nosedive faster than a meme stock after an earnings call. Backtesting helps traders separate the strategies that thrive in different market conditions from those that crash and burn at the first sign of volatility. It's the difference between betting on a hunch and making an informed decision. But here's where it gets even more interesting. Edwards introduces the concept of trade forensics, the post-mortem analysis of trades. Think of it as an autopsy for your investments. If backtesting is about preparing for battle, trade forensics is about reviewing the tapes after the game to see what went right and what went terribly wrong. Was it a flawed strategy, an unforeseen market shock, or just plain bad luck? Edwards explains how trade forensics digs into the details. Every buy, every sell, every timing decision, searching for patterns and pitfalls. It's not just about assigning blame, it's about learning. For the pros, every loss is tuition in the school of trading. They examine metrics like slippage, execution risk, and even the psychology behind a trade. Why did you hold on to that losing position? Why didn't you take profits sooner? These aren't just numbers on a screen, they're the fingerprints of your trading habits. And here's the kicker. This continuous learning loop is what separates amateur traders from the pros. Amateurs blame the market, professionals blame themselves, and then figure out how to get better. For every failed trade, there's an insight waiting to be uncovered. And that's what makes risk management not just a skill but an art form. As Edwards puts it, trading without backtesting is like flying a plane without instruments. You might make it to your destination, or you might end up in a nosedive. So, next time you see a trader make $1 million bet, remember, that trade was probably tested, tweaked, and torn apart 1,000 times before a single dollar was put on the line. It's not luck. It's preparation. All right, let's talk about hedging, a favorite strategy of hedge funds and one of the most misunderstood. It's all about balance, like walking a tightrope between risk and reward. Imagine you own stocks in an airline, and they're soaring. Everything looks great. But there's a storm brewing on the horizon, rising oil prices. Since fuel is a massive expense for airlines, even a small spike in oil prices could send your investment into a nosedive. This is where hedging comes in. By betting on oil prices going up, say, by buying oil futures, you can offset potential losses in your airline stocks. If oil prices rise, your futures position makes money to balance out the losses in your airline stocks. If they fall, your stocks do well. Either way, you've smoothed out the turbulence. This strategy isn't about making a killing. It's about staying alive, avoiding the wipeout that sends you crashing down to zero. But here's the catch. Hedging isn't free. It's like buying insurance, you pay a premium. The art of hedging lies in knowing when the cost is worth the protection it offers. Hedge too much, and you eat away your profits. Hedge too little, and a market shock could take you out. As Davis W. Edwards explains in Risk Management in Trading, hedging is less about eliminating risk and more about transferring it. It's about choosing which risks to keep and which to pass on. like a high-stakes game of hot potato where dropping the ball could cost you millions. Edwards dives deep into different types of hedging, like delta hedging, which uses options to neutralize the risk of price movements, and cross-hedging, where traders offset risks in one asset class with a related but different asset. Think of a chocolate maker who buys futures on sugar to guard against rising costs, or a tech company that uses currency hedges to manage the risk of a strong dollar cutting into overseas profits. Hedging is all about strategy, knowing which risks are worth keeping and which ones to hand off to someone else. And sometimes, hedging is a defense against your own worst enemy, yourself. The psychological side of trading is no joke. When the market turns south, even the most disciplined traders can panic sell. Hedging provides that psychological safety net, allowing traders to think clearly and stick to their game plan. Edwards calls this the paradox of protection. The idea that knowing you have a safety net often makes traders bolder and more decisive. But it's not all sunshine and rainbows. Hedging can also backfire, big time. Remember 2008? AIG sold massive amounts of credit default swaps to hedge against mortgage defaults. Except they didn't actually own the mortgages. When the housing bubble burst, those hedges turned into a tidal wave of liabilities. Edwards warns that hedging without understanding the underlying risks is like wearing a parachute with a hole in it. It might look safe, but it won't save you when it counts. That's why professional traders use hedge ratios to measure how much of their risk is truly covered. A perfect hedge might sound great in theory, but it can be a costly drag on profits. So, traders often go for partial hedges, covering just enough to manage their worst-case scenarios without sacrificing too much upside. It's all about balance, enough protection to survive a market crash, but not so much that you drown in costs if things go well. And here's the golden rule. Hedging isn't a one-time thing, it's an ongoing process. Markets change, risks evolve, and a hedge that worked yesterday might be a liability tomorrow. Successful traders constantly adjust their hedges, like a ship captain navigating through shifting winds and tides. As Edwards puts it, the best traders aren't those who avoid risks, but those who manage them with surgical precision. So, the next time you hear about a hedge fund making a massive profit, remember, it's not just about picking the right assets, but managing the risks around them. Now, if you've ever heard traders talk about the Greeks, no, not the ancient philosophers, they're referring to a secret language of risk in the options market. Delta, gamma, vega, theta, these aren't just letters of the Greek alphabet. They're the dials and levers traders use to navigate a landscape where every move can make or break a fortune. In Davis W. Edwards' Risk Management in Trading, he breaks down these metrics as the true language of options trading, like the code in the matrix. Once you understand it, you see the market for what it really is, a grid of risks and opportunities. Think of the Greeks as your options trading dashboard, each metric a different gauge showing how your investments respond to changes in the market. Delta, for example, measures how much your options price will move for every $1 move in the underlying asset. It's your speedometer telling you how fast your trade is moving. If you're long on a call option with a delta of 0.7, a $10 increase in the stock price means a $7 gain for you. Simple, right? But it gets deeper. Enter gamma, the accelerator. While delta tells you how fast you're moving, gamma shows how fast you're accelerating. It's the change in delta for every $1 move in the stock. High gamma can be thrilling, like a car that suddenly doubles its speed. But it's also dangerous. In fast-moving markets, high gamma can swing your profits or losses faster than you can react. And then there's vega, the measure of an option's sensitivity to volatility. If delta is your speed and gamma is your acceleration, vega is the weather report. High vega means a storm is brewing, wild price swings that could send your trades into chaos. For options traders, vega is the difference between a sunny day and a hurricane. Edwards explains how professional traders use vega to their advantage, seeking out opportunities when volatility spikes. For instance, during earnings season when stock prices swing wildly, Traders with a high vega can profit handsomely if they've positioned themselves correctly. But if they're on the wrong side, it's a one-way ticket to margin calls and sleepless nights. Next up, we have theta, the silent assassin. Theta measures time decay, the loss in value as an option approaches expiration. Imagine buying a carton of milk. It gets less valuable the closer it gets to the expiration date. Every day that passes, theta takes a little slice of your premium. This is why most options expire worthless. Theta slowly drains their value until there's nothing left. But here's where it gets really interesting. Edwards talks about how traders can turn theta into an ally. If you're a seller rather than a buyer, theta works for you, not against you. Selling options is like owning a grocery store. Every day that milk sits on the shelf, you're making money on someone else's fear of volatility. That's why many professional traders prefer to be sellers, not buyers, of options. And let's not forget Rho, the Greek that gets the least attention but can be a game changer when interest rates move. Rho measures how much an option's price will change for every 1% change in interest rates. In a rising rate environment, ignoring Rho is like sailing without checking the tides. It's subtle but powerful, especially for long-term options. Now you might be thinking, how do traders keep track of all this? Edwards describes how professional traders use risk management software that constantly calculates the Greeks, allowing them to adjust their positions in real time. It's like a fighter pilot's heads-up display. Every metric right in front of them, every second of the day. And here's the kicker. Understanding the Greeks isn't just about managing risk. It's about turning risk into opportunity. By mastering these metrics, traders can build strategies that profit not just when the market goes up or down, but when it moves fast, slow, or even sideways. It's a reminder that the most successful traders aren't those who avoid risks, but those who understand and manage them with surgical precision. So the next time you hear a trader talk about delta or vega, remember, they're not just spouting jargon. They're decoding the metrics of the financial markets. Ever wonder what happens if your trading partner can't pay up? That's credit risk, and it's a nightmare scenario for traders. It's like playing a high-stakes poker game and realizing, halfway through, that the other players might not have the chips to back their bets. One wrong move, one unreliable counterparty, and suddenly, your winning hand turns into a disaster. Remember the financial crisis of 2008? Credit risk didn't just play a role, it stole the show. When Lehman Brothers collapsed, it wasn't just because they made bad bets. It was because the entire financial system suddenly realized that nobody knew who could actually pay their debts. Trillions of dollars in credit default swaps, essentially insurance policies against defaults, started to look as valuable as monopoly money. Banks stopped trusting each other, and credit froze faster than a lake in winter. Davis W. Edwards explains in Risk Management in Trading that managing credit risk is about one thing: making sure the reward is worth the risk, even if the other side can't roll up their end of the bargain. And that's where credit value adjustments, or CVA, come in. Think of CVA as a reality check. It's the process of adjusting the value of your trades to reflect the possibility that your counterparty might default. In simple terms, it's pricing in the risk that you'll never actually see the money you're owed. But here's the catch. CVA isn't just about avoiding bad trades. It's about making them profitable, despite the risks. Imagine you're a bank trading derivatives with another institution. If that counterparty is rock solid, CVA is low and life is good. But if they're shaky, if they've got more red flags than a Formula One race, the CVA skyrockets, eating into your profits. So, traders have to balance it. How much potential profit is worth the risk of not getting paid at all? And here's the scary part. CVA can snowball. In 2008, as the financial storm gathered, the CVA desks at major banks were in panic mode, frantically revaluing trades as counterparty risks skyrocketed. It was a chain reaction. As the perceived risk of one bank rose, other banks jacked up the CVA on their trades, causing an avalanche of losses. Edwards compares it to being in a lifeboat surrounded by sharks. Every time one person panics and moves, everyone gets a little closer to the edge. And it's not just about banks. Hedge funds, too, are vulnerable to credit risk. Many hedge funds use over-the-counter derivatives, contracts traded directly between parties, not on an exchange. These private deals are great for flexibility, but terrible for credit risk. There's no central clearinghouse to guarantee payment, just you, the other party, and a whole lot of trust. That's why many hedge funds run regular stress tests, simulating worst-case scenarios to see how they'd survive if multiple counterparties defaulted at once. Edwards talks about another key tool, collateral management. It's like the security deposit when you rent an apartment. Before trading, counterparties are often required to post collateral, cash, or other liquid assets, as a guarantee they pay up if things go south. But managing collateral is a balancing act. Ask for too much, and you choke your trading partner's ability to do business. Ask for too little, and you could be left holding the bag. And then there's the ultimate nightmare, wrong way risk. That's when your counterparty's ability to pay up is directly linked to the success of your trade. It's like betting on a horse and realizing halfway through the race that the jockey owes money to the mafia. For example, imagine selling insurance on a bank's debt. If the bank fails, you owe them, but if they're failing, they can't pay you either. Edwards warns that wrong-way risk is like a trap door beneath the trading floor. Hard to spot until it's too late. So how do the pros handle it? One word: netting. Rather than settling each trade individually, many institutions use netting agreements, essentially offsetting what they owe each other, so only the net difference gets paid. If you owe me $1 million and I owe you $900,000, we settle for $100,000 instead of risking both sides defaulting. It's not a perfect solution, but it reduces the overall risk exposure, kind of like bailing water out of a sinking boat. And here's a pro tip from Edwards: the most effective credit risk management doesn't just happen at the desk level. It's built into the entire organization: who you trade with, how much you trade, and even the terms of the contracts you sign. It's about knowing the risks before you even sit down at the table. So the next time you hear about a bank or a hedge fund blowing up, chances are, credit risk was the invisible enemy that got them. Here's a plot twist: risk management itself can be risky. That's right, the very systems designed to save you can sometimes lead you straight into the jaws of disaster. In Risk Management in Trading, Davis W. Edwards tells a story that sounds almost too absurd to be true, a 200-page risk report that no one read. For 17 months, this report was being circulated to over 100 people, packed with errors and blank data, like a fire alarm without batteries. No one noticed, no one acted, and the risks kept piling up, unchecked. It's the financial equivalent of driving a car at night with a busted dashboard. You might be cruising now, but you won't see the cliff coming until it's too late. And that's the dark side of risk management, when it becomes an exercise in checking boxes instead of making decisions. Edwards calls this the illusion of control, the idea that as long as you've got a fancy report and a few charts, you're safe. But the truth? Analysis is useless without action. Risk management should be short, actionable, and directly tied to decisions. No fluff, no filler. Because when a crisis hits, no one has time to read 200 pages. They need a clear one-page summary that tells them exactly what to do. It's like having a beautifully detailed map that leads you straight off a cliff. Sometimes it's better to have a simple but reliable compass, something that points you in the right direction without drowning you in details. Edwards suggests focusing on the core risks, the ones that can kill you if you ignore them, and stripping away everything else. It's risk triage. Figure out what's fatal, handle it fast, and don't get distracted by the noise. Edwards also warns about risk complacency, the false confidence that comes from having sophisticated risk models. In the years leading up to the 2008 financial crisis, many banks used complex mathematical models that predicted only minor risks. They didn't account for the possibility that housing prices could fall nationwide, because historically they never had. When the crash came, Those models didn't just fail, they became traps, lulling traders and managers into a false sense of security. It was like the Titanic crew refusing to believe the ship could sink until it was halfway underwater. And it's not just about the models themselves. Edwards explains how organizational culture can turn risk management into a dangerous game of cover your assets. When managers are more worried about justifying their decisions than actually managing risk, you end up with risk reports that are more about avoiding blame than preventing losses. It's the kind of thinking that leads to 200-page reports no one reads, just so everyone can say they did their job. So what's the solution? Edwards suggests adopting a risk dashboard approach, clear, concise, and focused on key metrics that matter. Think of it like a fighter pilot's HUD: speed, altitude, target. No fluff, no distraction. In a crisis, traders need to see at a glance how much risk they're carrying, where it's coming from, and what their options are. Here's the billion-dollar question. How much risk is worth taking? Edwards argues that risk isn't inherently bad. It's a measure of the size of your bets. Think about it. Billionaires could eliminate financial risk entirely by giving away all their money. But would that make sense? Of course not. Risk is the price you pay for potential rewards. The trick is calibrating it to match your goals, whether you're a hedge fund manager or just someone trying to grow a 401k. Edwards talks about the risk-to-reward ratio, the golden rule of trading. For every dollar of risk you take, how much can you expect to gain? The most successful traders don't avoid risks, they embrace the right risks. Like poker players, they understand the odds and never bet more than they can afford to lose. It's about stacking the deck in your favor, one calculated bet at a time. But here's the kicker. Sometimes the riskiest thing you can do is not take risks. Markets change, technologies evolve, and opportunities disappear. Inaction can be just as dangerous as reckless action. Edwards calls this the paradox of risk, the idea that avoiding all risk often leads to a slow but certain loss. Like a ship that refuses to sail out of port, safe, but ultimately pointless. At the end of the day, risk management is part art, part science. You need the cold precision of math and the gut instinct of experience. As Davis W. Edwards explains, it's not about eliminating risk, but transforming it, taking uncertainty and turning it into opportunity. Every trade is a bet, and every bet is a risk. But with the right tools and the right mindset, you can make those risks work for you. The difference between amateurs and pros isn't just how they play the game, but how they handle the losses. Hit like, subscribe, and let me know in the comments what you think the biggest risk in trading is. Until next time, keep your risks managed and your profits high.